You know, this spring was supposed to be the season the housing market finally got going again. But that's not exactly what's happening. We're seeing some major economic shocks ripple through the system, and what's usually the busiest time of year for real estate, well, it's kind of stalled out. So let's get into why. So were you one of the folks expecting a big flood of new listings this season? You know, a ton of buyers jumping into the action? It's a totally reasonable thing to expect, especially after the last few years. But as you're about to see, the story is, well, it's just not that simple.
Yeah, the housing market is a really complex machine, right? There are so many moving parts. And right now, while some of those parts are flashing green and saying go, 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 there's one really big component that is just blinking a bright red warning light, basically hitting the brakes on the whole system.
Okay, so to really understand what's going wrong, we first have to look at everything that was actually going right. Because on the surface, honestly, the table was set for a pretty strong spring season. The economic signs were looking really promising.
I mean, look at this. These are the key ingredients you need for a healthy market. We've got a low unemployment rate, wages are growing, and in a lot of places, they're growing faster than home prices. And affordability was slowly but surely getting better. Like one chief economist said, the ingredients for improvement are there. So, what's the problem?
Well, the problem is an external shock. It's a major global event that's thrown this totally unexpected obstacle right in the path of the housing market's recovery. And it's creating this ripple effect that's being felt by buyers and sellers literally everywhere.
And this just perfectly illustrates the chain reaction. It's like a line of dominoes. It all starts with the war in Iran, which, as you'd expect, creates a ton of volatility in oil prices. That volatility then sparks these new fears that inflation is going to start heating up again. And what happens when people get scared about inflation? Well, mortgage rates, the cost of borrowing money to buy a home, they start to climb.
So the key takeaway is right here, and it's put perfectly by Joel Berner over at Realtor.com. This upward pressure on mortgage rates has become the single biggest roadblock, the primary barrier that's stopping the market from really taking off, even with all those other positive things we just talked about.
Okay, so we've established the why. Now let's dig into the data and see the what. How is this barrier actually impacting the market on the ground? The numbers, well, they tell a really clear story of a market that's cooling down right when it was supposed to be heating up.
And here it is. This is the number at the heart of the whole thing. As of late March, the daily rate for a 30-year fixed mortgage hit 6.62%. Now, for anyone thinking about buying a home, that percentage point makes a huge difference in what your monthly payment is going to be and your overall buying power.
And the immediate result? You can see it right here. Total mortgage application activity just plummeted a staggering 10.5% in a single week. That is a direct, immediate reaction to those rising rates as potential buyers hit pause and start to reconsider their plans.
And it's not just one data point either. This slowdown is happening across the board. The growth in new listings has slowed down to basically a crawl. The year-over-year drop in the median mortgage payment is the smallest it's been in 5 months, and purchase applications specifically are down 5% week over week. It's a widespread cooling for sure.
This slide just captures the core tension perfectly. It's like a tug of war. On one side, you have this positive pressure. Hey, your wages might be growing faster than home prices, which should make buying a home more affordable, right? But then on the other side, you have the negative pressure from rising mortgage rates. And it's basically canceling out that benefit, squeezing affordability, and keeping would-be buyers on the sidelines.
So, all this brings us to the big question. What happens now? With all these competing forces pushing and pulling, the outlook for the housing market has gotten a lot more uncertain. Let's see what the experts are keeping an eye on.
And yep, it all comes back to inflation. These global economic shocks have basically forced everyone to reset their expectations. The OECD, that's the Organization for Economic Cooperation and Development, they've had to seriously bump up their U.S. inflation forecast for the year, from 3% all the way to 4.2%. That shift in thinking is a huge reason why rates are staying high.
And this quote from Lisa Sturdivant really just sums up the whole situation we're in. That rebound we were all hoping for is being tempered, is being held back by these outside forces. So what we're left with is a market that's way more limited and a lot more uncertain than anybody really expected just a few months ago. So this is where we land. It's like all the domestic ingredients for a healthier housing market are right there on the counter. You've got low unemployment, you've got wage growth, stable prices, but this one primary barrier, high mortgage rates driven by global instability, is keeping the whole recipe from coming together. The real question now is, what's it going to take to finally break down that barrier? That's what we'll all be watching.